Well, we're going to break some of this down now with our market reaction as well to all of this. But let's bring in Hennion and Walsh Chief Investment Officer Kevin Mahn. Kevin, good to have you on. So as we're seeing a bit of choppiness in the markets today, a lot there that they're trying to dissect. What are you focusing on and what you think is really moving the needle today?
Yeah, it's certainly been a great quarter this week. We hope that can only continue, and it looks as though we might be able to squeak out another positive close today. But what's really moving markets thus far is the belief that the Fed may ultimately turn less aggressive by the end of the year. And when I say that, Rachelle, I'm not suggesting that they're going to become dovish, but just slightly less hawkish with one of those final two meetings of the year involving an interest rate hike of less than 75 basis points. That's important to investors because it signals that perhaps we've now reached peak hawkishness and by definition and extension, also peak inflation. And history shows that in the 12 months following peak inflation, generally the markets move higher by an average of over 11.5%. So that's certainly a potential tailwind.
Kevin, when we take a look at the likely action then from here to the end of the year, I know you're saying that maybe we could see this upside trajectory, I guess. What do you think the gains would potentially look like, though, over the next 2.5 months?
Yeah, I think there's another potential tailwind, Seana, coming in November as well, that being midterm elections, as history once again has shown us in the 12 months following midterm elections, going all the way back to 1960, that the market moves up on average 16.5%. We also know that generally the stock market performs best when we have a divided government. And it appears, at least as of now, as though we're going to have a divided government after November. So I think those two specific events are going to give the investors enough confidence to move cash off the sidelines and redeploy that into U.S. stocks. The question then becomes, which areas should provide you with the most upside potential in that type of environment? And I don't want any of your listeners right now to believe that I'm suggesting that the days of volatility are behind us, because they're not. I also don't believe that inflation is going back to 2% overnight, because it's not. I also don't believe that the economy is going to stop short of a recession, because it likely won't. But that doesn't mean that investors should try and time the market and get out of the market and try and time when to decide to get back into the market. Look at the last 2 days as an example. Who would have known when things seemed the darkest that the rebound was going to start to take place? And this may not be the ultimate rebound. So position yourself defensively, stay true to your risk tolerance, and look for those areas of the market that perhaps will participate the most in the rebound.
What are those areas, Kevin?
Great question, Dave. The first area that I would start with is the healthcare sector. Healthcare has historically performed best during periods of economic slowdowns up to and through recessions. But Dave, there are two ways that you can access the healthcare sector. One is through those large cap traditional pharmaceutical companies like a Merck or a Bristol Myers Squibb that pay attractive dividends and also have a lot of cash on their balance sheet to deploy to potentially purchase. And here's the other way to access the healthcare sector: smaller cap biotech stocks, such as Axum Therapeutic, which we happen to hold within our Smart Trust Healthcare Innovations Trust. There's another area that we think will have significant upside potential, as we've noticed a pickup in M&A activity in the biotech space since May. If that continues, that could be another area providing alpha potential to investors in the months ahead.
And Kevin, as we gear up for earnings season, what are some of the companies that you're keeping an eye on, and what are you watching with valuations as well?
Yeah, valuations are certainly very attractive right now. You have the PE of the S&P 500 trading around 16.75 versus a 10-year average of nearly 23. That's attractive across the board. But some of the most beaten up areas have been in the technology and consumer discretionary sectors. As a result, those areas stand to experience the greatest rebound if and when investors feel comfortable in those areas again. Notably, e-commerce, names such as Amazon, which has unmercifully taken a big hit down thus far this year. But earnings isn't going to be great in the third quarter right now. We're expecting a blended earnings growth rate around 2-3%. That would be the lowest since the third quarter of 2020. But looking ahead is where we see the opportunities. If the consumer starts or continues to spend as they have thus far in 2022, and if, in fact, the Fed does turn less aggressive. If they do, that bodes well for stock upside potential, at least for the balance of this year, into the early stages of next year.
Kevin, what about the news that we got from OPEC earlier today? Oil moving to the upside on the news of the larger than we had initially expected, the production cut of 2 million barrels a day. How are you looking at that from a market and from an investment perspective?
We have to remember, Shauna, that a lot of the OPEC producing countries were already producing below their quotas. So the overall impact upon oil prices across the globe won't be as severe as those headline numbers might suggest. Regardless, it's going to have an impact on a global economy that continues to slow down due to these record-setting inflationary pressures led by energy. So that will be a drag on the economy. Now, with bad news comes a silver lining. That silver lining could be perhaps that the Fed won't be as aggressive as a result. I mean, we even heard the United Nations earlier this week suggest that the Fed should slow down and other central banks should slow down as well, given the potential damage to the worldwide economy. So with every piece of bad news that we receive these days, there's a silver lining in that it may cause the Fed to ultimately be less aggressive, and that may stave off a more deeper or severe recession than would have occurred if the Fed goes too far.
All right, Hennion, Walsh, Kevin Mahn, good to see you, sir. Thank you.